Hey guys, what's going on? Welcome back to Stocks with Surfing. Today we're going to be breaking down 3 world-class businesses that I believe are true long-term compounders. Now, I'm a big believer in transparency, so these are not just tickers on a watch list. These are significant positions in my actual public portfolio. I track my performance and my profits and losses right here every single week because I want to show you exactly what business ownership looks like in real time. Let's get right into stock number 1. The first stock is QXO. Now, think of QXO as the Amazon of construction supplies, led by billionaire Brad Jacobs, a man famous for turning small industries into multi-billion-dollar giants. Instead of just selling one thing, QXO is buying up hundreds of local suppliers. They become a one-stop shop for everything from lumber in your walls to the shingles on your roof, a whole house. Model cemented by their massive $2.25 billion Kodiak acquisition in February 26. What makes them a tech-enabled beast rather than just a warehouse company is their use of vertical AI. They use high-end algorithms to automate pricing and predict exactly what materials contractors need before they even ask, squeezing millions in extra profit out of thin air. With the current revenue run rate of $13 billion and massive target to hit $50 billion by 2035, the growth potential is staggering because they're digitalizing a massive old school industry that has been stuck in the past for decades. So now let's take a look at some of the growth metrics for QXO. First, we have the 34% revenue CAGR. Most companies celebrate a 5% growth. QXO is engineered to grow at 34% every single year through 2030. They don't just wait for customers to find them. They buy the customers by acquiring established companies like Kodiak. This is a massive compounder that Wall Street is just starting to price in. Next, tripling the addressable market. Before this month, QXO was mostly a roofing company. But with Kodiak acquisition on February 11th, they tripled their target market to $200 billion. They've moved from just the top of the house to the whole house, adding lumber and windows and doors to their catalog. Now we have the AI margin expansion. Brad Jacobs isn't just buying warehouses, he's buying data. His goal is to double industry average margins using AI. He's already targeting $90 million in immediate synergies from the Kodiak deal by plugging them into QXO's tech stack for pricing, procurement. This turns a boring building company into a high-margin tech platform. And finally, we have the $11 billion liquidity. Now, this is probably the most important part for QXO. Since they are an acquisition-based company, they need free liquidity to be able to go out there and buy new revenue growth. So having $11 billion post-Kodiak deal, post the Beacon deal is massive. They can go out there and buy a big player and grow revenue at a very fast rate. So now let's take a look at the valuation for QXO to see if it's at a reasonable valuation. So first we have price to sales. Now this is a trust metric. In a traditional lumber or roofing company, a price to sales of 1.3x is standard. QXO is currently at a multiple of 3.9x, meaning investors are paying nearly $4 for every $1 of revenue. This premium exists because the market isn't valuing a warehouse. They're valuing Brad Jacobs' track record. They expect them to roll up the industry so fast that today's price will look cheap compared to tomorrow's massive revenue. Next, we have gross margins at 25.3%. This is the scale metric. It measures what's left after paying for the actual materials, lumber, shingles. Most local mom and pop shops hover around 23%. However, QXO's high margins show their purchasing power. Because they buy in such massive bulk, they get better prices from manufacturers. Even a 2% difference at QXO's scale equals hundreds of millions of dollars in extra cash. Next, we have the adjusted EBITDA margins at 11.1%. This is the efficiency metric. EBITDA is basically operating profit. By targeting 11.1%, while the industry average is 8.5%, QXO is betting that their vertical AI can trim the fat. This includes things like using AI to optimize truck routes and warehouse staffing. If they hit this target, it proves their technology makes them fundamentally more profitable than any traditional competitor. And finally, let's cover the analyst price target. While the stock currently trades in the mid to high 20s, top analysts like those at Benchmark have set targets as high as $50. This represents a strong buy sentiment, signaling that Wall Street believes the recent $2.25 billion Kodiak acquisition was a masterstroke that hasn't been fully priced into the stock yet. Now, I think right now QXO is at a pretty reasonable valuation. As you can see in my public portfolio here, when I bought this thing, I'm already up like 30% or something like that, which is absolutely insane. This company has had a crazy a year, and I think it will continue its run as Brad Jacobs continues to acquire more companies. Remember, this is probably a 5 to 10 year hold, so that's the kind of time horizon that I'm expecting from QXO. But if this stock is rather volatile, so I expect it to have big drawdowns as well as go up significantly when it does move up. So if this company goes down 20% again, I think I'm going to be looking to buy. The second stock I want to talk about today is Netflix. Now, Netflix really needs no introduction. It's the world's leading entertainment service with 315 million paid memberships. They've evolved from a library of licensed content into a global studio that owns its own IP, hosts live sports like NFL and WWE, and now operates a massive digital advertising network. Now, the recent news with them is the merger with Warner Bros. Has been sort of put on hold as they granted Warner Bros. A 7-day waiver to hear a best and final offer from Paramount. But despite this, the Warner Brothers deal is still backing the Netflix deal. A special shareholding meeting is officially set for March 20th, 2026 to vote on the merger. If this goes through, then Netflix gets HBO and DC Universe. And CNN, it turns them from a streaming app into a global home of entertainment. Now, they won't get a lot of the legacy assets. Like, they're not going to get a ton of the cable stuff because that's all not really what they want. What they want is the streaming because that's the actual successful part of Warner Bros. The news media stuff and the broadcast is sort of a dying in the entertainment sector. Now, let's go on and look at Netflix growth. So, we'll start with the ad tier revenue. Now, Netflix is no longer just a subscription company, it's an advertising giant. They're on track to double their ad revenue to $3 billion this year alone. They're winning market share from YouTube and TV networks because they have the highest attention audience in the world. And as you can see, next we're going to look at their total revenue. It's currently sitting at $51 billion with a target of $75 billion by 2030. Now, this 14% revenue jump is about more than just memberships. It's the result of pricing power and live events. By adding things like the NFL and WWE, Netflix is becoming an appointment service that people refuse to cancel, allowing them to raise prices without losing users. Next, we have their operating margins at 31.5%. While their competitors, Disney Plus and Paramount, are struggling to break even, Netflix is hitting a 31.5% margin. They're spending more efficiently on content while their infrastructure costs are staying flat. This means every new dollar of revenue is dropping straight to the bottom line. And finally, I want to look at paid subscribers. And well, they just crossed 325 million. That's a crazy milestone. Even though the US is full, they're seeing double-digit growth in Europe, Latin America, and Asia. In some countries, 40% of new signups are choosing the ad tier, which makes Netflix more money than the standard plan, as the revenue is so good. Now let's take a look at the current valuation and what you would be paying for Netflix today. So before we get into this, it's important to note that the Warner Brothers acquisition has been a reason for Netflix stock to drop recently because it sort of scared investors since it is so expensive for them. Now, I'm not worried about their ability to pay it off because they can definitely afford it. I've made a video about that in the past. Go check it out if you haven't seen it. I give an in-depth explanation to how exactly they can afford the deal. But it is nice to know that the stock is significantly off the highs at this point in time. So let's look at the valuation. The forward PE ratio is currently 30.4x. So this compares the current stock price to the earnings per share expected over the next 12 months. Traditionally, Netflix trades at a growth premium of 44x. Today, it's trading at only 30.4x, a level similar to its 2022 lows when growth actually stalled. The catch, in 2022, they were growing at 6%, but today, they're growing at 15%. So you're effectively paying a value price for a growth engine because the market is irrationally scared of the merger deal. Now, I just want to make it clear that 30.4 forward earnings is not cheap. By this metric, you're paying a pretty fair price. So next, I want to look at PEG ratio. PEG ratio is the price to earnings to growth. Ratio takes the PE and divides it by the annual growth rate. So a PEG ratio under 2% is usually the green light for growth investors. At 1.6, Netflix is cheap relative to its earnings, but it tells us that for every 1% of growth you get, you're paying a much smaller premium than you would the other tech giants like Apple or Nvidia. But once again, like PE ratio, 1.6x on the PEG ratio is actually fair value. It's not that cheap. Now, if it was hitting now 1.2 to below 1, I'd say, yo, this is a crazy deal. We need to start buying this right now. Now let's look at price to sales. This measures the total value of the company against its annual revenue. So Netflix price to sale is down from its 5-year median of 8.1x. This compression happened because the stock price dropped. Well, revenue actually accelerated. This creates a valuation gap where you are buying a more dominant, diversified company for a smaller multiple of its sales than you were 2 years ago. Now let's look at free cash flow, because I do think that's like the ultimate metric, because it's the hardest for them to sort of play with. So this is the cold hard cash left over after the company pays for all its movies, shows, and servers. And most streaming services, they lose cash, but Netflix is a cash printing machine. Their $11 billion in free cash flow is the reason they can even consider buying Warner Bros. Discovery. It gives them a fortress of a balance sheet that allows them to survive high interest rates and massive acquisitions that would bankrupt smaller competitors, quite frankly. So the third and final company we're going to talk about today is Brookfield Corp. Now, for those of you that don't know, imagine a single company that owns the hydroelectric dams powering your city, the cell towers connecting your phone, the data centers running your AI, and the skyscrapers in Manhattan. Now, that's Brookfield. They're a global investment giant that specializes in real assets, physical things like pipelines, railroads, and power plants that generate steady cash. They have two main tricks. First, they use their own massive bank account to buy these assets when they're on sale. Second, they manage other people's money like pension funds to do the same, collecting a fee for being the exports, while most tech companies sell code. Brookfield sells the physical backbone of the global economy, and right now they're pivoting hard into AI infrastructure and clean energy to catch the next 50 years of growth. Now let's look at the growth of Brookfield. So let's start with fee-related earnings. So think of Brookfield's management salary. They manage $603 billion of other people's money, and for that service, they collect $3 billion in fees. Last year, a 22% jump. This is the highest margin part of the business because it doesn't require Brookfield to spend their own money to grow it. They just use their reputation to attract more capital. Now let's look at distributable earnings. Wall Street loves distributable earnings because it's the cold, hard cash available to pay the dividends. It grew 11% on a per-share basis to a record of $5.4 billion. This growth is impressive because it happened while interest rates were high, proving that Brookfield's assets like pipelines and toll roads are inflation-proof. Next, their insurance assets. The Wealth Solutions division is the secret growth engine. They grew their insurance asset base by 24% to $157 billion. By buying insurance companies, they get float, cash they can invest into their own high-yield infrastructure projects. It's a genius loop. They use insurance premiums to fund the world's power grids. It's similar to what Warren Buffett has done with Berkshire, where he takes insurance premiums and then invests it in the market. The difference is Brookfield puts it into physical assets. Next, we have the AI infrastructure pivot. The biggest hidden growth metric is their $100 billion AI program. Brookfield is partnering with NVIDIA and Microsoft to build the physical layer of AI. They aren't betting on which AI app wins. They're betting that every AI app will need the massive data centers and nuclear power that only Brookfield can provide at scale. Now, if you even go farther than that, if you look at stuff like Google, they've done renewable power deals with Google, where they're the exclusive provider of electricity to, say, a new Google data center. So let's take a look at the current valuation of Brookfield Corp. Now let's start with taking a look at fee-bearing capital. So imagine a machine that prints money every time someone else invests. That's Brookfield's fee-bearing capital. Right now, they manage over $600 billion for massive clients like pension funds. Every single dollar in that pot pays Brookfield a fee just for being the exports. Their goal? They're trying to double it to $1.2 trillion by 2030, which would be absolutely insane for their fee-bearing capital. Next up, we have the plan, the triple up goal. So at roughly $48 today, the stock is basically on sale. Management's plan is to triple that value over the next 4 years by growing their earnings at a massive 25% every year. They've outperformed the S&P 500 for 3 decades, and they believe the move into AI infrastructure is the biggest opportunity they've ever seen. For an investor, this isn't just a stock, it could be a blueprint to triple your money by 2030. And to do that, well, they have a war chest of $188 billion in dry powder. While other companies struggle with high interest rates, Brookfield has been able to capitalize on it in the past, and one of the reasons why is through sitting on $108 billion in cash and credit, they're ready to capitalize on any opportunity at any moment, no matter what the market is currently saying. So those are 3 stocks that I think have the ability to compound your money over the long term. All of them have bright futures, in my opinion. Now, remember, none of this is financial advice. These are all my own opinions and my own reading of the situation. I hope I gave you guys some ideas to do farther research yourselves on these companies. And yeah, that's the video. If you like it, please comment, subscribe. Comment if you think I did and if you think I said anything wrong, if you disagree with one of the companies, or if you have your own company you want to share with